All right, good morning, good afternoon, and good evening, wherever you may be, and welcome to this webinar by Fintelekt and Asian Bankers Association, supported by our knowledge partner KX. May I request all the panelists to come on a line as well? Thank you. So, welcome, panelists.
Thank you, Shirish.
Great, all right, we have everyone here. So,
Thank you. Thank you,
thanks,
Shirish.
thanks, Madhu. All right, audience, my name is Shirish Pathak. I work at Fintelekt, and it is my pleasure to be your host again today for this webinar. At the outset, let me express my deep gratitude to friends at the Asian Bankers Association, Ernest Lin, Amador Honrado, and Mig Moreno for their untiring efforts in bringing together the ABA membership and other institutions across Asia for educational sessions like this one today. As you all know, the title of today's webinar is a comprehensive approach to financial crime compliance surveillance. And we have four esteemed speakers with us today, and each of them will present thoughts on the topic based on their own experience. The speakers today are John Dalton, Vice President and Global Head of Financial Services Product and Solution Strategy at KX, Zubin Chichgar, Head Monitoring and Analytics at Standard Chartered Bank, Madhu Sinha, Independent AML Compliance Professional and former Head of AML at Citibank India, and CJ Mhatre, Business Head, South Asia and ASEAN, KX. So again, Madhu, Zubin, and CJ, thank you so much for joining us today. We will start the webinar first with a presentation by John Dalton. That will be followed by
Thank you.
Zubin, Madhu, and CJ in that order. Since John is based in the US due to time difference, he could not join us live, but we have pre-recorded his session. Before we start his session, let me say a few words about John. He oversees the vision, strategy, and roadmap for KX Financial Services products and solutions. He has previously managed the anti-financial crimes products and solutions for SAS, BAE Systems, and IST. With over 20 years of experience designing, building, and delivering technologies for combating financial crime in financial services, insurance, healthcare, and government, John brings a wide breadth of knowledge to the market. Can we have John's presentation now, please?
Good morning, good afternoon, good evening to everyone. My name is John Dalton. I'm Senior Vice President of Financial Services Product Strategy at KX. It's great to be with you today. I'm really excited to talk to you about the concept of surveillance in today's banking world. And hopefully you'll gain some keen insights that might support strategies that you're looking to employ, both from a technological perspective as well as an operational one and moving forward. So why surveillance and why now? I'm going to walk through what that means and how it impacts you and your institution and in fact, society at large. So we all know that in today's world, everything has been moving to digital for quite some time. There are multiple new products and services available to your customer base that have not previously been available before. And that includes things like mobile payments, text payments, bank-to-bank money transfer technologies, and more. And what this is creating is an ecosystem of intense complexity. Data growth is exponential. There's no question that that path will continue into the future. And that complexity of data coming into the organization at the velocity and volumes that it is leaving financial institutions blind to both risk and opportunities, especially across lines of business. So what is required in an effective surveillance system for today's world? Well, first, you need a continuous, actionable intelligence environment that can look across multiple lines of business. It needs to be able to support real-time decision making and literally microseconds in some cases. It needs to be deployable as a hub and spoke within your ecosystem so that you can connect those lines of business across those multiple different payment channels and other digital systems importing information into the institution. Why do you need these? Well, because it's going to provide you the best offense and defense strategy and enable you to combat today's ever increasing sophisticated financial crimes. What are the benefits? Well, one, we can help reduce regulatory compliance costs, which is of course front of mind for all compliance officers and executives. We can increase investigation accuracy and efficiencies and fidelity, which inspires your investigators by removing a lot of the noise that they have to deal with on a daily basis, which turns out to be false positives, for example. We can help stop fraud more effectively while simultaneously reducing customer friction, which we all know is a serious issue. And most importantly, from some viewpoints, we can protect your shareholders and your hard-won reputation in the market and keep you out of the newspapers for all the wrong reasons. So next, I want to go through what the ecosystem of surveillance actually entails. What's underneath the covers? What are the areas of focus and concern that we're specifically talking about? So here, we're showing a visual representation on the left of an example of the different types of lines of business in a traditional or non-traditional financial institution. It's not an exhaustive list, it's a representative list. But we've got some banks now squarely into crypto asset and cryptocurrency. We've got retail, wholesale, commercial, correspondent, trade as examples. And in each one of these lines of business, to the right, we have a myriad of areas that need detection and monitoring and action. So the circles in yellow, of course, are matters pertaining to regulatory compliance. So anti-money laundering, transaction monitoring and detection. Spin-offs from that are, of course, things like illegal wildlife trafficking, concerns about elder abuse, drug trafficking, human trafficking, knowing your customer. So KYC and customer due diligence all fit into this equation. And of course, sanctions. To the left, obviously fraud, but more and more so in today's world, we're talking about digital payment channels for fraud, sanctions, and reconciliation. And then cyber. So many jurisdictions now are requiring financial institutions to report cyber information when they file reports such as a suspicious activity report to the government agencies. So this is a very complex ecosystem where everything's intertwined, and you need a surveillance capability that can tie all of that together and make sense out of it in very quick fashion so that you can move from reactive state, which is what most systems that are antiquated in today's world offer, to a proactive response state so that you can effectively have command and control of your enterprise and make informed, fast decisions. So quickly, I'm going to walk through some measures and metrics and concerns across that ecosystem we just talked about. I think we can all agree, over the last 2 years, the uptick in regulatory fines has been significant. 2019 into 2020, they were up 141%, almost 200 fines globally against financial institutions. KYC, CDD, especially with issues around the pandemic, caused account opening delays to be significant, which is causing customer friction. The cost of that is significantly upticking. On average, it's $6,000 US to open an account. So that's a significant burden on bank profitability. And of course, could mean customer churn if you can't get them onboarded quickly enough. So we talked about cyber activity and regulatory compliance. Cyber attacks are up over 46%. And now, again, required to be reported through compliance channels, but it's becoming even more complicated with recent ransomware attacks, where the criminals executing those ransomwares are asking for payment in cryptocurrency. And if your customer is transferring funds from their accounts to buy those cryptocurrencies to facilitate the ransomware request, it presents you with quite a compliance challenge that not very clear, at least right now, and exactly how that's going to be dealt with by the regulators. So additional concerns, we've already touched on payments, but payments fraud is up 81%. It is believed that at least 2 out of 3 millennials are impacted by some type of payment fraud annually at this point. Sanctions is obviously a very important tool for nation state governments combat financial crime, but we're not doing a particularly great job because you can see that there's already been $10.4 billion in fines associated to that up through 2020. Trade-based money laundering is getting more and more focused by regulators, namely because it's a very effective way to launder money. And the estimates are that in excess of $1 trillion a year. For criminals, it's fewer transactions, larger transactions, and the ability to move money more rapidly. So we've touched on virtual currencies and assets. Crypto fines are starting to become a very real thing. As you can see below, the SEC 175 million and CFTC at 23 million. There's no expectation that the regulators are going to back off from this. They're going to continue to focus and employ new regulations. So getting a handle on this now, early on, is critically important. Vulnerable populations and social advocacy. I personally am seeing a number of financial institutions setting up teams to deal specifically with these topics, whereas they used to be part of the broader mix. But concerns with human trafficking, drug trafficking, elder abuse are real. Elder abuse in particular in many jurisdictions, it's expected that for every single case of elder abuse that is reported, 44 other ones are not. So it's a very serious matter that needs to be addressed. So what does this look like in your ecosystem to deploy an effective surveillance capability and technology? So here again on the left are our lines of business. Most all of them are digital channels in today's world. Some are still over the counter, but they're feeding data in continuously. Again, with enormous velocity and volumes going into multiple core banking systems. So in the first, you want an ability to sit at the head of the stream, as I call it, and provide yourself a capability for streaming analytics to support continuous intelligence. So that enables you to begin making those microsecond decisioning, whether it be for fraud, whether it be for sanctions, payments reconciliation, and so on, as we discussed earlier. So that will help you, as you see the continuous value stream below, provide a real-time threat assessment, reduce customer friction, and give you those proactive responses. Now, as that data comes through those core banking systems, it's persisted into many different types of core banking data repositories. It could be centralized data warehouses, Hadoop data lakes, federated repositories, and so on. And it's very important to be able to tie those things together so that we can have a time series understanding of events, because criminals don't attack us in one particular area. They can attack us across multiple lines of business. So being able to assimilate the time series behavior against the activity is critically important, thereby providing you a 360-degree view of risk. Now, you probably already have in place existing systems that have valuable historical profiles. And so you want to be able to leverage that data as well as part of your analytic strategy to give more context and better results. Now, ultimately, you may choose to start turning those systems off, but to have a capability that can run in parallel while you make those decisions, and probably a multi-phased approach is critically important. But the information is only valuable if it can be distributed to the various stakeholders in the institution with appropriate consumable risk metrics. In other words, providing you a very clear understanding of what's taking place against what timelines, so that you can have complete command and control of your enterprise and provide a proactive response as opposed to being reactive. So the salient point is, in today's increasingly complex world, to catch a criminal, you've got to think like a criminal. And employing an effective surveillance capability across your enterprise, across multiple lines of business, is one effective way to combat them and start mitigating the threats and the risk more effectively for the future and for today. So thank you very much. I hope this was informative. If you have questions, my contact information is here on the screen and can be provided to you. I'd be more than happy to talk in more detail about these different initiatives.
Great. So that was a presentation by John Dalton of KX. Participants, if you have any questions, please use the Q&A window to post them. John's colleague CJ is live with us today, so he will be happy to take any questions at the end of the webinar. Our next speaker is Zubin Chichgar, who, as I mentioned earlier, is currently the head of monitoring and analytics at Standard Chartered Bank based in Singapore, building and implementing the surveillance program for the bank. A few words about Zubin before I invite him to speak. He is an accomplished compliance management and leadership professional with a wealth of experience building and leading compliance and AML surveillance operations for major international banks and driving delivery of transformation programs to solve complex business issues and regulatory challenges. Zubin has a track record of defining, developing, and implementing global policies and procedures related to financial crime, regulatory and compliance issues, as well as risk appetite governance and reporting. Zubin, thank you so much for joining us today, and the floor is yours.
Thanks, Shirish. Okay, to start off with, and if we look at financial crime compliance surveillance and the whole definition and quite a bit of items which John touched on, that's at a stage of evolution which has come up over the years. And you can go to the next slide, please. If you think about it over the years, and we've been those who've been playing with this for a fair bit, you would recognize that when you started off historically, you would have what you would call exception reports. These exception reports then evolved over time, coming up and more robust rule-based systems. What is coming up now is at the cusp of a change, and which comes a paradigm change is, are these good enough? Where do we need to run? And it's getting more and more into what you would call behavior-based and monitoring and screening rather than simple transaction-based. Now, slight differences. Transactions, historically, you were looking at, hey, why is this transaction greater than X dollars? Then it moved into customer and account base. Again, it was activity, but wasn't spread across things. Now it is evolving into behavior. So next slide. The perennial challenge which comes up in terms of surveillance systems is the problem of plenty. And when you define surveillance, different organizations may call it out differently, but what we are trying to look at is monitoring, which will be post facto of transactions for AML and potentially fraud behavior. But also sanctions-related screening, and sanctions-related screening could be name screening of potential clients or existing clients. So it could be onboarding screening or periodic screening, as also transaction screening, which is effectively before a transaction really hits the books over there. Now, the definition of financial crime has moved. It moves differently in different organizations. Some would be dealing with it only on monitoring and screening on AML and sanctions, while other organizations may even bring things like fraud into the coverage over there. But if we look at question getting out in the industry will vary dramatically depending on which geography you are based in, which lines of business you're based in. And the question will be, oh, what is the market number for a SAR yield? How many SARs per 100 transactions, so as to speak? And you're not really comparing apples to apples because it's so very divergent. And the question is, you may have a pristine bunch of clients who are not doing anything. So what are you going to report SARs on? So that discussion keeps happening, but it is definitely a dilemma that you're spending so much effort, but your output is relatively limited when it comes to rule-based monitoring. Okay. So next slide, please. Now, these are the emerging frontiers. Of course, you've gone through a decade and a half or 2 decades of running rule-based monitoring, and largely driven by regulatory expectations, but also we must remember it is not only because you have to do it from a regulatory perspective, it's also in a way the right thing to do in terms of the spirit of actually combating financial crime. More and more it comes up in terms of a balancing act, which comes into play in how do you get what is a true and correct view rather than only a true and fair view now, as well as balancing it against efficiencies, or could we call it inefficiencies. So you're always going to have a struggle between the two. If you have very liberal thresholds to catch almost anything and everything, you're going to have a lot of noise coming in the system. But then you're going to increase your thresholds significantly, you're going to miss a lot. So how do you satisfy both ends of it? To add to it, again, what John alluded to is the emergence of new products and channels. Digital has been an enabler, but also a bit of a dilemma and a pain for us, because the speed of transactions which comes out, you need to be able to respond to it fast. The evolution of the products, the way products are booked, you have aggregation on one end, you don't have information available if you just take the normal data, you need to go underneath to really peel the onion and get the information. And how do you keep evolving on your monitoring platforms to be able to get the relevant data point which you have? That's why data is coming up as a very, very big dependency. A lot of entities will go out in terms of deployments of the systems, and you're going to spend a whole ton of money in getting the data right. If your data is not right, your monitoring is compromised. And this needs to be a sort of maintenance issue. You just can't deploy it once and assume that your data is going to be constant. You need to be able to monitor the data by itself. So you have a monitoring system around data in terms of ensuring data lineage, data completeness, and data accuracy. One of the ways which is coming up in terms of getting this, in terms of efficiencies, etc., is integration. How do we integrate the various verticals to get a good view on the customer or the counterparty? We have data in institutions. How do you use it? Why do we think in silos in terms of, oh, this is a sanctions related information, I don't want to see it in money laundering side. Oh, this is fraud related, I don't want to see it over here. What about credit information? The credit information has been really useful during the time of pandemics when certain companies have been a bit stressed, and there was a high sort of correlation in them doing something naughty in terms of trying to make a quick buck during this particular point of time. But that got informed by leveraging credit information. So this is something which is getting more and more into the sort of pipeline in terms of how do we integrate all these items and think about financial crime risk in totality. I would even talk about and hazard a term in saying that we are familiar with MLRO, Money Laundering Reporting Officer. But if you think wider, is it Financial Crime Reporting Officer? Is that scope now evolving over there? Okay. Next slide, please. So very often, immediate response is the buzzwords. Everything is going to get solved if we throw in machine learning, artificial intelligence, robotics, etc., etc. But the question is it going to be so simple to do it? To get these things running, you need real good data. You need training data out over there. Now, it does add its value. It does help in getting your efficiencies. But at the end of it, the people who really need to talk about it, to train the system, are the humans. There is still a very, very heavy dependency on humans to be able to train the system to do it. It is getting more and more mature when it comes to the screening space, because you have generally a lower level of uncertainty. You have more a binary information, is the name or the term a match or not a match, as against when it comes to money laundering in terms of you're filing a suspicious activity report. You don't know whether it is really suspicious unless you get feedback from the authorities. Fraud also is, in a way, something which you know. Is it something where you have prevented a potential loss, or is it a loss? The training system is there. But ML is something where the jury is still out, still baby steps happening out over there. But I would still emphasize this is an aid rather than a complete solution by itself. The human element is still very much required on this particular vertical out over there. Okay, next slide. And with it, of course, comes governance. So wherever we look at the power of AI, ML, or systems as a whole, even without this, a lot of emphasis on data comes in. And data quality, you have CDOs, office, chief data officers, offices which are being constituted. Audit teams will look at the data being fed into your system. Have you taken in all the data which is required? Are you picking up the data from the right place? With analytics coming in and a lot of tilt towards analytics, moving away from rule-based to be able to get good efficiency ratios, and it does work. But with it, you have model governance. One should definitely not underestimate the effort on this. It's a complete day job for somebody to do it. It's not something on the side. You need the expertise, you need teams to be able to have explainable models, to be able to maintain it and to defend it by independent reviews. There is recently there is a update by OCC on models. They have come out with a guidance in August. That's pretty good to read. It follows up from an earlier guidance, which was sent out way back in 2011, 2012, but it has now evolved on this. And what is also coming out is self-attestation in certain countries, where individuals are attesting to the fit and proper operations of the system. And it is more like the historical Sarbanes-Oxley, where it is a personal liability coming up. Of course, it's not yet called out as personal liability, but it's a named official of that particular location signing off that the system is fit and proper. It is doing what is expected to do, and where it is being maintained on a regular basis. So the next couple of slides actually talk about a few of the documents which talk about monitoring and screening. So FATF, of course, has their monitoring guidance, which I propounded. It talks about what it needs to look at. It talks about risk-based assessment. That's one of the places where we talk about monitoring, having a risk-based approach on it. The next slide is the one which talks about quite extensively on governance. It talks about monitoring and screening over there. It's worth a read. Of course, this particular regulation is only applicable to institutions governed by NYDFS, but it's really a well-written piece of regulation, which more and more regulators are referring to rather than actually enforcing, but it's informing a lot of decisions. And you'll see it is being driven by risk assessment right up to training. It doesn't just throw it out and saying you can deploy a system and sit back on it. And finally, the last piece of information which is there is, of course, the MAS guidance, which came out in 2018, which talks about the whole life cycle of knowing the client, risk-based calibration, implementation checks, and of course, a resolution. So these are a couple of guidance and regulations which are worth reading in terms of how the industry is moving. Okay. So, thanks, Shirish. Back to you.
Thank you so much, Zubin, for that presentation. I realize you have to get into another meeting right now, but you have time just for a minute to take a question.
Sure, that's okay.
So we have one by Asean who says, should we look at SAR conversion as a percentage of transactions or SAR conversion as a percentage of alerts generated? And what percentages are a good representation of effectiveness in TM?
So the first one is if you take it as number of transactions monitored, effectively that's your smallest denominator. When you're doing business, that's your cost to business. Now, of course, you can argue that is that the correct parameter? Like historically, you would have written a check for $10,000 if you need to do something, but now you're going to use your ATM and do a withdrawal of 1,000 whenever you need it. So the number of transactions has gone up, but the value may have gone down. So there needs to be that particular element also built in over there. It's not just numbers as such. And as I said, percentages, personally, I don't think that's a good indicator. One SAR could be significantly impactful for the law enforcement against 99, which are just, you can call it defensive SARs. You will see a higher trend of SARs in certain geographies who say it is suspicious unless proved innocent as such. So it is like, unless and until they don't have a valid reason to say it is okay, they will file a SAR. Majority of the regulation regions as such will go the other way around on that. So you will have a tendency of that particular geography having a higher reporting ratio. Again, certain types of clients are prone to have more reporting. Like say, for example, if you have correspondent banking business where you don't know the underlying, you're not going to get the information. So you're going to have more reporting over there. So I wouldn't really hold it out. I think each organization should have their own trend and see whether you're moving from that trend.
Right. Thanks, Zubin. Zubin, before you go, there's a question which says Zubin spoke about guidance issued on models. Can you let us know who issued that guidance?
I'll send you that detail.
Great, excellent.
Okay?
So
it's OCC.
OCC, all right. Okay.
Yeah. Thank you.
Great. Thank you so much, Zubin, for joining us today. It was a pleasure having you. All right. Our next speaker is Madhu Sinha, independent AML compliance professional and former head of AML for Citibank India. Uh, Before Madhu starts, let me just say a few words about her. So Madhu has worked in banking and finance industry for 34 years. She was the director and head of AML at Citibank India for 5 years before retiring recently. Before that, she served as the head of compliance at GE Capital India and also held senior level compliance positions in India's two leading banks, that is State Bank of India and ICICI Bank. In her long career, Madhu has handled diverse facets of banking, such as AML and regulatory compliance, retail banking, banking operations, international trade, finance, NRI banking, and remittances. With that, Madhu, welcome to the webinar. The floor is yours.
Thank you. Thank you, Shirish, for that introduction. And good morning, good afternoon to everyone. So my topic that Shirish has given me is a comprehensive approach to trade transaction surveillance. And can we move to the next slide, please? So these are the topics that I will be talking on in the short time that has been provided. So essentially, we are going to talk about how to effectively combat trade-based money laundering. What is the importance of trade-based money laundering in the entire AML and FCC space, and why it gets called out always as the most important one. And next, what are the tools that we have? What is the current monitoring scenarios that is available to us? And with the help of these new tools, like AI, ML, where do we want to reach to be able to more effective in getting the trade TBML effectively? And also, what is how the data sharing between different counterparties in the trade space can work, and what are the regulators expecting? What is the international standards expecting from financial institution in this scenario? Can we move to the next slide, please? Yeah. So first of all, the challenges in trade surveillance and the importance of trade in the space of anti-money laundering and TF. The importance of trade comes from the fact that, and this is something that we all must be knowing, that 30% of all money laundering globally is getting conducted via trade. Why is it so? The reason is that trade is complex in nature, and because of its complexity and volumes are high, billions of transactions going through the financial institutions every day, it becomes easier for any criminal to pass his or her channels. And of course, there are multiple counterparties involved, multiple databases involved. There are not just importer and exporter, buyer and seller that is involved in a trade transactions. There are multiple intermediaries, port authorities, payment systems, both banks and payments companies. And each one has its own database. Each one has its own vulnerability in terms of detection of AML. All of this makes transactions a very lucrative way for the criminals to hide his illicit. Is that the criminals are also getting more sophisticated. They are using variety of products, variety of payment channels. There are online platforms, trading platforms, e-commerce platforms, which can be used for passing of trade payments. There are non-banking payment channels that have sprung up in almost every country, and which provide maybe at times those are not really regulated, and therefore it is easier for any for these criminal enterprises to pass the trade payments through them. And also use of platforms like shell companies, multiple banks to move funds across borders. All of this is making it more and more complex for a financial institution to really identify the money laundering happening through trade transactions. So let's go to the next slide and see what are our current system and controls that we have in the financial institutions, which are and whether they are geared up enough to detect. So first thing, and this I can talk from my experience as a practitioner of AML in multiple banks, is that we are working in multiple silos, right? And very often the trade transaction units are a separate set of trade analysts, which are processing and the actions, and they have a team which is doing the customer profiling and customer monitoring. And very often the two teams are not very synchronized with each other. Even the platforms and the software they're using are not very synchronized, not talking to each other. Add to that the huge volumes. There are simple rule-based red flag indicators that they have, producing large, in fact, huge number of alerts every day, making it all the more difficult for them to really detect the money laundering going through trade. They are not very, as I talked, they're not very conversant with the customer profile all the time. They have to reach out to the relationship managers of the clients to get a better sense of what the customer usually does and whether or not the transactions that they are dealing with will be counted as suspicious. Then the other part is the trade finance transactions, which constitute some 15% of the trade globally. There, because there is a comfort that we know the customer very well before financing them. So everything that they do are supposed to be kosher. So there's insufficient monitoring traditionally happening for these trade finance clients. But of late, it has been found that even in trade finance, there have been fraudulent transactions. Many countries have faced it. India, where I come from, there have been huge cases of frauds in time relating to some very white collar trade finance clients of the banks, where the banks have lost billions of dollars in the recent years. So trade finance is no longer kosher. Fraud and money laundering can both happen through the trade finance platforms also. So there we need to kind of beef up the AML monitoring and fraud monitoring. The holy grail of trade happens to be the detection of over and under invoicing. Unfortunately, we do not have any very effective system or database which can detect the over and because the criminals are getting smarter. They are often keeping the under and over invoicing just under the radar, which makes it very difficult for them and shared in all countries. The price list of a variety of products are not often shared with the financial institution, making it all the more difficult for them to detect over and under invoicing. Most of the trade globally, if I talk, happens through 85% of the trade goes through open accounts where only payments pass through the banks. So we are aware of documents, the trade bill of lading and other documents, invoices, etc., not even seen by the banks. They are seen only in 15% of the cases. It's the port authorities who have access to these, but then those databases are not often available to the bankers. In some countries, there have been some new initiatives whereby to make these databases available to banks. In India, we do have such databases which have now become operational, but I'm not sure if other countries also have it. And those countries where there are no where the currency is free, all the more difficult because these trade payments are passing through banking and non-banking platforms through faster payment methods and making it a hell of a lot difficult for a banker to trade, please, and see how in this current scenario we can effectively combat TBML. Can we go to the next slide? Yeah. So I talked a moment between trade and customer profile teams. The idea for effectively combating TBML is to create a context, a holistic view of trade relationship, a holistic view which includes customer profile, the counterpart combined to give an AML and FCC analyst a 360-degree insight into what's happening, how the customer is supposed to behave based on his past behavior and his profile, and vis-a-vis the transaction that he is handling. The other important part is to understand the trade relationship. Now, we know that every trade relationship has multiple counterparties. So there will be importer and exporter. We need to know what each of them are doing, where they are in the world, geographic companies that they are trading with, integrate this information with the sanctions and blacklist checks. So sitting at one place, an investigator has a complete knowledge of what the customer is doing, what the counterparties are doing, and what kind of business they are into, and what to expect and not to expect, what is making sense, what is not making sense as far as the trade transactions are concerned. We also need to caution, we talk the trade is a complex business. So many a time our false positives are emanating from the fact that we have simple rule-based RFIs which give us false positive alerts. And at times the transactions which should be legitimate are also caught in those false positives. Some examples that I would like to share with you are like, for example, in a mining company doing a trade with a textile company. Now, why should a mining company, which is normally dealing with manufacturers and machine parts, heavy machinery kind of business, why will they buy trade with a textile company? The question could answer to that question could be that they are buying uniforms, right? Similarly, a seafood producing company, why would they deal with an electronics company? The answer could be a refrigeration system is what they could be buying to keep their produce safe. So these are some of the examples of how an AML investigator in trade has to go beyond the transactions and look at what is plausible, what is not plausible, and then try and identify the real suspicious behavior through use of innovation and real-time analytics. And when I talk of real-time analytics, I am looking at a more comprehensive approach, which we can look at in the next slide. Can we go to the next slide, please? Right. So what the answer to the challenges in the trade-based space, in money laundering space, is to have a more comprehensive and multilateral approach. The collaboration and data sharing between public and private sectors. There are many examples of public and private sectors coming together and try and make a more effective trade-based money laundering methodology. There are many countries where different regulators and other parties that are involved, like port authorities, the customs authorities, have all come together on this puzzle on who controls what kind of data, and can that be shared across all the stakeholders and made use of. One example, as I already talked about, is in India, where the customs authorities have put out all the customs data, invoice, bill of lading data onto a platform, which can be used by the bankers, and a comprehensive view of what trade has happened from a particular customer, and has he completed that trade, has he got the money, with whom has he done the trade, etc. So that's a useful approach. There are other public-private partnership examples like GMLIT and Fast-Track Fintelekt Alliance, which have come together and try to bring together an approach which can be sharing of information between banks and the law enforcement authorities, port authorities, regulators becomes possible. Another way of looking at comprehensively approaching TBML detection is to keep upgrading the red flag indicators, keep moving from a simple rule-based RFIs to more complex and scenario-based and profile-based RFIs, which are using more technology and real-time analytics available with the banks. Also, sharing of fraudulent trade data and typologies will be useful. Many regulators are already doing it, sharing the typologies emerging in the trade space, and fraudulent trade data is being shared with all banks to keep them aware of who are the customers who have conducted fraudulent activities with other banks. One thing we all need to do as banks is to reduce the dependence on manual checks, because the number of alerts are huge. in billions every day, and probably using the artificial intelligence and machine learning that my previous panelists also talked about will be of use. What we need is to use these technology to connect all the data sources that the bank has with it, the customer data source vis-a-vis the trade data source, the transaction data source, and use the AI and ML to bring them together and make sense of what the customer is doing. And also, as far as possible, reduce the burden on the trade units to take decisions, and maybe have solutions with intelligent decision making. There are many companies which are coming up with this kind of solutions, where the intelligent decision making is also done with the help of AI and ML, and it will be of good use to use any of them. So with this, I will pause and will wait for any questions that the participants may be having. Thank you.
Thanks, Madhu. Thanks for the presentation. We will come back to you in a few minutes' time for questions after CJ has finished speaking. So our next speaker is CJ Mhatre, a business head, South Asia and ASEAN at KX. Welcome, CJ. Before CJ starts, let me just say a few words about him. CJ Mhatre is working towards bringing globally accepted cutting-edge technology to the financial markets of South Asia and ASEAN, thus enabling leadership teams to make timely, effective, and informed decisions. CJ has invested over 20 years building businesses within the treasury, risk management, and payments domain with companies such as Thomson Reuters, SunGard, and Swift, and has served the needs of banks across Asia Pac. With that, CJ, over to you.
Thanks very much, Shirish. I hope I'm audible and visible clearly.
Yes.
Good afternoon to all friends. Good morning, wherever pertinent, to friends outside and within Asia. We at KX, including myself, John Dalton, who spoke a while earlier, we engage with compliance, AML, payment fraud departments at global banks, financial institutions quite regularly. Today, Shirish wanted me to bring out some of the trends, issues, challenges that we've seen, heard in the market, and share them with you, specifically around surveillance compliance strategies that teams often face. What are financial crime compliance teams looking for when it comes to kind of technology? So I'll try and share that quite succinctly in a short span of time. There's quite a bit of content, but I'll try and keep it quite brief. I hope it's interesting to all of you all. So in this day and time, financial institutions all over the world have to meet, as you're aware, a number of regulatory and compliance requirements, which require calculated planning, establishing of anti-money laundering, surveillance, fraud protection strategies. Regulatory compliance, as you would agree, consists of a huge umbrella of initiatives within the financial institutions to protect them legally, financially, reputationally. The feedback that we get from the emerging markets that we've now started speaking to quite actively at home and heart, Philippines, India, Bangladesh, Indonesia, Sri Lanka, isn't very different. What we hear is that both the traditional and the non-traditional financial institutions are considering all aspects of AML and surveillance when determining their overall regulatory compliance program. In this very fast-moving environment, financial institutions are increasingly left blind, vulnerable to risk exposure, sometimes powerless to identifying true opportunities. In this kind of newer digital payment channels, as new digital payment channels emerge, and given that the volume and the velocity of data continues to grow exponentially, managing it is of utmost importance. Many a times, compliance and IT teams using existing legacy technologies, all analytical strategies are pretty much unable to offer the fraud regulatory protection that's required in today's very fast paced institutions. So what do banks consider when drawing up an AML strategy, a surveillance plan? They tell us they are reconsidering the transaction monitoring methods and systems that have been used over the past several years. Now, this is key because antiquated batch architectures that are perhaps over 10 years old, leveraging outdated rules, tend to generate a plethora of false positives, and really aren't focused on systemic behaviors. This causes delays. Consequently, there is an immeasurable business cost as well, many a times. In our conversation, the topic of KYC came up. During a KYC stage, institutions are running an increasing number of account opening delays. As John alluded to, CDD onboarding is time-consuming, extremely expensive. Access to timely, accurate information is missing many a times. Many of their current risk assessment models lack predictive abilities that would be needed to detect and stop a threat from happening, either today or perhaps recurring in future. An interesting fact that Treasury and Risk analysts stated, the FBI's Internet Crime Compliance Center, IC3, have shown an upward increase of 37% on ransomware incidents, a 47% increase in associated financial losses. Now, these are pretty big, scary numbers. Crypto continues to grow. Now, with this growth comes increased risk. Compliance teams globally are constantly ramping up their monitoring systems to try and stay a step ahead. Payment in virtual currencies has now become an extremely attractive method for money laundering. Now, while regulatory violations continue to skyrocket and regulators, governments continue tightening restrictions, institutions, on the other hand, are looking for newer technologies that may have emerged in the recent past to evolve, and with this increasingly savvy tactics that continue to be used by financial criminals of today. So what's needed? A fresh mindset, a comprehensive AML surveillance strategy, and an appropriate investment plan, which is quite important, are the need of the hour. And we are glad at KX to say that the financial institutions across Asia are taking steps, investing in the right direction, guided in many cases by central bank recommendations. Incorporating a successful AML strategy when financial institutions decide to invest in a comprehensive is really starts when a decision is taken to invest in a comprehensive surveillance program, a program that goes beyond just monitoring, detecting, or flagging behaviors, instead offering actionable, continuous intelligence of the institution's landscape for identification of both risk as well as opportunity. Institutions globally, as also in large Asian centers of South Asia, Southeast Asia, are tending to break the mold. They are seeking access to real-time data, microsecond decisioning, kind of moving away from that historic reactive response mode to a more modern, proactive, intelligence-driven environment across all of the lines of businesses, products, services. It's interesting to note that the market is realizing that a full-scale surveillance ecosystem that offers both an offense and a defense strategy is really needed to effectively combat today's sophisticated financial crime and compliance. If you can move to the next slide. Very quickly, what should institutions consider when investing in a very comprehensive financial crime compliance strategy, investing in surveillance technology? Firstly, they need to ensure that the surveillance program can be quickly deployed across individual and multiple digital channels. This is needed in order to combat illicit trade behaviors, payment fraud, regulatory violations such as money laundering, terrorist financing, sanctions violations. It should not just reduce regulatory compliance, but also increase investigation accuracy and efficiency. The challenge for financial institutions is to evaluate their present technologies. Let's face it, everyone's invested in technology in some shape or form. And for them to determine how these incumbent existing technologies can be modernized, can be adjusted to address, let's say, the massive data onslaught, the ever-changing threat environment that we experience today. Some steps that we at KX would like to mention, perhaps like a guideline or a benchmark for institutions looking to invest in a surveillance ecosystem. Firstly, audit. Perform an audit of your existing processes, practices. This will help you identify the root causes of your problems, gaps in your existing system, in your existing process. Inspect the quality of data. It's very important. What sort of data is received? How is that data received? What's the impact of the data on your end results? Seek guidance from your internal team members during this audit. Do not hesitate to employ an external third-party consultancy along with experienced technology providers, perhaps your incumbent technology provider, to conduct this audit. It is a worthwhile investment. Closely review during this process all your existing regulatory mandates that could be focused on lines of business requirements. This will help you determine your immediate as well as your kind of futuristic needs. Once the shortfall has been identified, that's the time for you to sort of start building up a project, either for updating, replacing, or perhaps augmenting your existing technology. Do not at this point in time be shy to go to market. Considering evaluating alternative technologies that may have helped banks your size mitigate this risk globally, regionally is quite prudent. Consider investing in streaming analytics that can be sort of deployed in front of a core banking system, perhaps natively in the payments processing channel for a more proactive approach. Employ advanced analytics for anomaly detection. Kind of discovering risks as you go can be highly risky, pretty expensive in the longer run as well. If you're looking to augment your existing transaction monitoring system, try and get a entry-level 360-degree behavioral risk analysis, post-generation of alerts. This will definitely help cut noise, reduce false negatives considerably. If you're looking at replacing an existing system, consider investing in scalable technology. Thus future-proofing your organization. Consider technologies which are versatile, cloud-ready, or cloud-native. Because let's face it, friends, cloud is the future. Another thing to consider is data. What's your regulatory policy on data? Where can data reside? On-prem, on cloud? It will be a good investment to put together a very clear, comprehensive system evaluation process. Perhaps include a paid POC. Look at client referencing. Lastly, cost. Cost is important, but should not be considered in isolation or for short-term augmenting of your existing system. Rather look at it from a futuristic point of view, from a scalability perspective. Consider an overall kind of a TCO. So these are a few things that we would sort of recommend. Again, it's more of a guideline, not any kind of a comprehensive process, and hope it's sort of found useful. As I come to the end of my kind of allotted time, I suppose we are kind of overrunning a bit. A final question to get our compliance and technology professionals in this audience thinking. Have you optimized your surveillance technology, updated your compliance approach recently? And if the answer is no, then my friends, the time to start is today. That's all from my side. Thank you, be safe, and back to you, Shirish.
Thanks, CJ. CJ and Madhu, thank you so much for joining us today and sharing your thoughts. I'm sorry we can't extend the webinar too much to answer the questions, but we'll hope to get some answers back from you offline.
Thank you very much, Shirish, for having
Thank you.
us. Really
Thank you,
enjoyed being
Shirish,
here, and thanks to
CJ.
the audience.
So participants, thank you so much for joining us today. I trust
audience. Bye-bye.
Useful. My sincere thanks again to the Asian Bankers Association for partnering with Fintelekt for this webinar and for KX for being the knowledge partner. This recording will be available later on Fintelekt Academy, so please visit fintelekt.academy to watch this recording if you missed part of it, and to watch any of the previous webinars. So keep learning and see you at the next webinar.